We ask our family, we ask our friends, like, hey, have you ever done this before? What's the feedback? What do you think about this, right? So they're asking these things to people that they trust, but those people might not necessarily have the right answers or enough experience to give them, the consumer, enough information to make a decision that's best for them. Maybe their friend or family member only purchased, a couple homes in their life, right? So you're only gonna get so much experience out of a transaction or two.
So on a credit report, it's your minimum obligation on a credit card. So if I have a $2,000 balance on a credit card, the minimum payment might be $75. That's my monthly debt. You might pay actually more at that, but that's what I count as debt. Your car loan payment or your car lease payment, that's my debt. Student loan payment, that's my debt. And then whatever the mortgage is that we're projecting is going to be.
Some of the top mistakes that you see buyers make out there.
Besides buying a car the week of closing, should be normal spending habits are okay, right? Oh, I pay my credit card, I make my car loan payment, we do this, we do this. Anything that's kind of off the grid spending wise, it should be a flag of the fact that maybe I should bring this up. The biggest one that I've seen recently tick up is actually gambling, right? Like your DraftKings and things like that, they self-report their winnings in a lot of situations.
Hey, Dan Gouveia here from the Greer Real Estate Team, and joining me today is John Libman from Guild Mortgage, and we're going to be bringing some talking points to buyers and sellers in the real estate journey and just giving a value and talking about some different things that may be helpful to the consumers out there. So, John, thanks for joining me today.
Yeah, thanks for having me, man.
Excellent, excellent. So, just a couple things. I guess we'll just start off with.
Well, you kept talking about pain points, right? Yeah. And that's what kind of started this whole conversation about this, right? You were saying like, what is, freezing somebody that's looking to buy? Maybe someone that's just been a lifelong renter. How do I make that next step? Just maybe it's someone that has an expanding family. Like, how do I think there's just like this rabbit hole you can go in on Googles and different things like that. And is there like a trusted source of actually, I can just get some straight, transparent answers?
Right.
Realistic answers, not going down that WebMD approach.
Yeah.
And I think that's what this really all started from, right? Something like that.
Yeah, absolutely. And, a couple topics we want to talk about today, but it will probably go off to other branches of more details of certain things and maybe some conversations. So just really a relaxed environment and talking about, about experiences and what we're seeing out there. So, So what are some of the pain points that you're seeing with consumers out there?
Really, what are the common questions that I get up front, right? So normally when I'm connecting with somebody, the first couple questions I get is, I'm green, I don't know what to do. This person told me to call you. They said that you'll be able to give me advice, roadmap. They don't know what to say on the other line.
Right.
So that's usually the first conversation we're having. So I'm like, okay, perfect, right? So then we just start educating, right? I think that's where you start, okay? Basic questions, right? Let's just get on like a process when we're talking about having this call is, hey, do you rent? Or do you live at home right now? What do you pay for rent?
Right.
Okay, how much do you know how much you would feel comfortable paying a mortgage for, right? So say maybe someone pays rent for $1,000 a month. Are they comfortable at $2,000 on a mortgage? It's a great first starting of the conversation. Have you put any money aside for down payment money? Right? What's your time frame? Some people are in lease agreements for 3 months, 6 months. Maybe they just inked a 12-month lease. There are processes to get out of those leases, and you could probably share some light on those. Those are usually the initial calls and questions, and then it comes down to obviously monthly payment, and then the cash out of pocket to do so, right? As those conversations continue, really we kind of go towards more of an application at that point so we can give the right guidance. But credit scores, there's a lot of different things. And I think, during this talk today, we're going to kind of cover a lot of that stuff.
Yeah, I agree. Definitely education. I feel that consumers out there, they're listening to a lot of people like friends and family. And I understand that's a comfort level. And I think we all are guilty of that at some point as consumers.
Yeah.
We ask our family, we ask our friends, like, hey, have you ever done this before? What's the feedback? What do you think about this, right? So they're asking these things to people that they trust, but those people might not necessarily have the right answers or enough experience to give them, the consumer, enough information to make a decision that's best for them. Maybe their friend or family member only purchased, a couple homes in their life, right? So you're only going to get so much experience out of a transaction or two, right?
And when, right? Did this person purchase 20 years ago? Did this person 5 years ago? Was it the heart of COVID? When did this purchase take place? And I think that changes everything when you're dealing with an expert like yourself.
Yeah, so I feel like the consumers definitely, they get a lot of information coming at them at once, but a lot of it can be, the wrong information. So they get confused. And I think a lot of time it kind of sets the point where they don't do anything. You know, they're just kind of stuck. So that's what I'm finding. I think for them to get in touch with the right professional, whether it's a lender, an attorney, and a realtor that's in the area that they want to purchase in or sell, you know, that's where they can really get educated on the facts and statistics and analytics, and so they can make the best decision, you know.
Yeah, and having those early conversations doesn't mean you're committed to this person, right? At the end of the day, you're almost we're kind of interviewing each other, right? I'm interviewing this borrower, and they're interviewing me at the same time. We may or may not be a good fit.
Right.
We don't know yet.
Right.
That's the biggest part of it, right? And then that's what's kind of nice with they're doing it not, oh, I'm talking to all these people on a Friday and I'm going to see an open house on a Saturday and trying to make it. It shouldn't happen that fast. It can, it does, but it shouldn't. Maybe the journey's a month of kind of meeting and greeting and getting a feel for the right team that works for you, right? And then as they keep going, because the more we're educating during that process, they're making a major decision. I mean, you're with them when they're making that decision and writing the paper. You know, you're calling someone like myself and we're going through those numbers, but they're making a massive, more than likely, largest financial decision they've made to date, unless they went to a very expensive school, but to date, and they have to make this in like 2 hours.
Right.
You know, does it make sense, right? I think the more we go over those numbers, it's easier to make that decision, I think, for themselves.
And I think for a lot of buyers or consumers out there, I think, you know, the beginning of their journey is searching online, whether they're going to Zillow, like they're shopping first.
Yep.
You know, and then
it's like buying a car. Where do you go first? You step on a lot, right? Like that's when you start looking at cars, right? It's the same concept.
So they don't necessarily start talking to a lender right away or do their budget, but I think it's important for them to kind of analyze their own budget that they have now.
Agreed.
You know, what are they bringing in for income? What are they paying out every month? What does that look like?
Yeah.
What's their debt now? You know, what can they afford? And that's where the whole affordability comes in. So when they meet with you, you kind of go over this.
Yeah, because remember, we're qualifying somebody based on a debt ratio, right? It's gross income divided by monthly debt. Now, the monthly debt that we're accounting for, unless you're doing like a veteran loan or something like that, is mostly everything that's on the credit report. Okay. So on a credit report, it's your minimum obligation on a credit card. So if I have a $2,000 balance on a credit card, the minimum payment might be $75. That's my monthly debt. You might pay actually more at that, but that's what I count as debt.
Right.
Your car loan payment or your car lease payment, that's my debt.
Right.
Student loan payment, that's my debt. And then whatever the mortgage is that we're projecting is going to be.
Right.
Right. So, but that's not all your expenses. Maybe you pay daycare. That's a very big cost. Maybe you like to travel. Maybe you go to dinner all the time. Maybe there's a lot of different cost structures that we're not accounting for, and that goes into that budget that we're talking about. So budget and where you qualify for, two different numbers.
Right, everybody has a different lifestyle, so obviously that comes into play.
Definitely.
A good point. So at that point, they can start to get a picture of what they can afford and what they can't at that point.
Yep. I agree. And that's usually one of the first steps. They say, look, I can tell you what you qualify for, but you are going to have to tell me this budget number. And then we actually almost work backwards from there. Because if we know their max number is, say, $3,000 or $1,500, we know what their down payment needs to be and what sales price to work backwards to say, hey, look, this is really where you want to be. Right. So then when you guys are going to look at properties, one, they have a comfort level of that area, or maybe for the right house, they're willing to push that comfort level a little bit.
Right.
Yeah.
True. Good point. So based on, you know, interest rates and down payments and, you know, what can you talk to the consumers or the buyers about that, you know, I guess maybe some different programs that might help with some of those things or?
Yeah. So in those initial conversations, I mean, one rent versus buy, right? That was kind of one of the things that we were talking about. It's a constant comparable, like why rent when you can buy, right? Or you're paying your landlord's rent. I mean, this is like, it's always like these things that we say. I ran a quick little just breakdown off of estimates that we've seen over the last 6-12 months on rates, things like that. If someone was buying roughly a $400,000 property and putting down, say, 5%, estimating what tax and insurance may be on that, you might be looking at somewhere between, you know, $3,100 to $3,300, depending on what those taxes and insurance might be. Over a 5-year window, you're going to pay down $22,000, $23,000 on that mortgage, right? So now I owe, say, $358,000, $357,000 over that time frame, where I started maybe at $380,000, where I've made all those mortgage payments, but also my property that I own has appreciated 5%, whatever that number is over that time frame. So what did I really gain in that ownership compared to renting, where if you paid $3,000 a month over 5 years, I mean, you've invested, what, $180,000 in payments, and you don't own anything. at that point, right? You can't even put a hole in the wall if you want to, right? But that was one of the things I know we originally started with the rent versus own.
Yes.
Yeah.
So based on the down payment they put, to buy a home, and you talked about the appreciation of homes, 4 or 5% a year, right? I mean, someone could get, depending on, the size of the loan and so down payment, they can get half the deposit back probably in a year appreciation. Or
Yeah.
2 years, So the money they're spending, the down payment, they're getting that back and in appreciation equity in the home.
Yeah.
A lot of people will say, well, that's great, but the money's not in my bank.
It's not physically in my pocket.
Right.
Yeah.
It's not in my pocket. I'm not going to sell the house I'm not selling the house to get it back.
Yeah.
But it allows you year 5, year 6, right? And can you refinance, pull money out, maybe buy investment property?
Yeah, there are opportunities as the properties appreciate in value that you might be able to use the funds that you've gained in there. Just like when people have retirement accounts, right? They don't really plan to touch them until they're 65 or whatever age they plan to retire. But in a pinch, could they go and get a loan against it for $10,000 or something like that? Yeah, you can, right? It's kind of nice to have that, but that's how we build retirement, right? You're also building that in that home.
Right.
It doesn't mean you're touching it every day, but that is true. And with down payments, that's a big question that when people call. What's the down payment requirement? What's the down payment requirement? Now, there are certain down payment assistance programs, right? I would say the most common first-time home buyer is putting down anywhere between 3% to 5% down. Okay, so if we were talking about a $400,000 property, this could be anywhere between, say, $12,000 to $20,000 that someone's putting as a down payment on a property, right? That's most common. There are certain state, we call them bond programs, but state housing. So like your mass housings, your Rhode Island housings, things like that. They'll have upwards of, you could get 15,000 and sometimes 20,000, even upwards of 30,000, depending on which state and which potential down payment assistance program you may qualify for, right? They are all credit driven, right? So you need to have certain credit scores depending on the program. They're area restrictive sometimes, right? And income restrictive, right? So those are things. So if you're thinking about those, or you might be one of those candidates, or you're, oh, could this work for me? Definitely message us and, let us know. And we're happy to reach out and kind of see if you might be able to qualify for one of those programs too. But there are some great down payment assistance programs for people too. Yeah,
because one of the things I was looking at the other day, and it's just as part of the income requirements you talk about, is in different counties. It's amazing how high they are. So, average consumer out there might think that, I make too much money, I don't qualify. But, some of these counties, 125, 160, if they make under that household income, they can get approved for these down payment assistance. And I feel like a lot of people don't know that. They just feel like,
a lot of
I make 100,000, I'm not going to qualify for anything.
Yeah, a lot of it's based on area median incomes. So you can even go to just generic websites and type in, what's area median incomes in certain areas, in certain counties, and you'll actually see this. Some of them per county, like as you get closer to Boston, right, these limits go higher, right? As you get closer to certain areas, they go lower, right? It just depends on what that median income actually is, right? So some areas you might see them in the 70,000 world, some you might see them in the triple digits, in the 100,000s world. So I think it will depend, but again, that's part of why, it's good to kind of connect with someone like yourself and myself, and we can always kind of dive into where they might fall into those criteria. Also, some of them are household income driven, right? So maybe someone's not applying for the mortgage, but because they live in the house, that's going to go towards that threshold. So that also is the case. And depending, someone might have a second job or other sources of income. So it's just really good to dive into it, I think, and actually see where you fall, because you don't want to be banking everything on this and you may actually exceed the limit, or maybe you don't make enough.
Yeah, sounds good.
Yep.
So how about like a self-employment buyer? How's that different than someone that gets a W-2 and works for an employee?
Yeah, I find a lot of first-time home buyers are self-employed now. I think that generationally, I think a lot of people like to work, start their own companies, things like that, because they don't necessarily always want to work for somebody. I think that we've seen that shift happen, or at least I feel I've seen that a lot. And so a lot of those early questions of, well, I'm self-employed or I just started my business, how does that work?
Yeah.
I know what's cool is a great time to connect or start thinking about it heavily on as a self-employed person is when it is a turn of the year, right? So like your December timeframes going into like January, February, these can be really good timeframes to start talking to a lender, real estate, things like that, because you're about to do your tax returns, which we lean heavily on, which we pretty much lean on, to do your self-employed income. If you've been in business for 5+ years, we can a lot of times lean on the most recent return. If it's been less than 5 years, we're usually going to average these 2 years of returns, right? So that's really valuable in that. Now, there are specialty programs out there. So if you have a very unique income style where you get a lot of cash and you have a lot of deposits that you're made, there are creative ways where you can do bank statement loans and things like that. If maybe the tax returns don't always show your true profit, there are other avenues for that too.
Yeah, because if you're self-employed, I mean, they're trying to get as many deductions as possible.
Of course, that's what you do, right? Yeah.
And, they really have to have good books and good bookkeeping as well.
Yeah.
Because they're going to be easier for them and for you also to help qualify them. I feel like
It does make my life easier. They're organized.
So, exactly. So, having good, maybe you can explain to the self-employed buyer, like what's important about, how to keep their books straight, like what they're going to need from you to make that process easier for them to qualify.
Yeah, I think it's depending on the type of self-employed, right? So you have some people that are just filing a Schedule C, which is on your personal returns. Sometimes you have people with S corps or you have corporations. But normally the first question is usually, how long have you been in the business? That's it. Most of those people will have an accountant. If you don't have an accountant, I definitely recommend it. If especially you're looking to buy in the upcoming years and you're self-employed, having an accountant or a bookkeeper, someone that's going to have this organized, I think there's a lot of value there. The other part too is a lot of times we want letters from them referencing that you've been in the business for X amount of time frame and they've been the ones filing your tax returns. So there's a piece of that too, but also you're just kind of double checking yourself to make sure that you're doing it correctly if you're self-employed. But we're going to usually grab those federal returns. We don't really don't want the state as much, right? So it's going to be like your federal business returns, like if they're corporate, S corp. Then you'll get sometimes in scenarios you'll get these things called K1s. It's kind of like a W-2 sometimes for a self-employed borrower. So you'll get those too. And then, hey, remember, there's also people in certain businesses that claim tips. That's another thing that people do. The biggest one that I've seen recently tick up is actually gambling. Right? Like your DraftKings and things like that, they self-report their winnings in a lot of situations. So I've just recently been talking to a couple people in how do we do that. So that's another one, but again, it's considered self-employed. So if you have a 2-year history of filing this on taxes, it almost sounded very similar to almost like claiming tips in a certain industry that you might have. Right? But it's really self-reporting. So that's another piece that's kind of new with a lot of the laws changing federally. So
interesting.
Yep.
So what can you kind of touch on, or you feel like some of the top mistakes that you see buyers make out there?
Besides buying a car the week of closing? No.
Yeah. Or spending some of the deposit on vacation.
Yeah, you had that happen. I remember we were talking about that.
We had a house house was under agreement. I was representing the seller. We had a signed purchase and sales agreement, and the buyers were away on vacation and spent a little bit too much money. They spent some of their down payment money on vacation.
Yeah, had a little
They didn't
fun.
tell their bank about it. That they're doing a finance, so they went out to another bank and applied for a personal loan.
Yeah.
To,
which is a no-no.
To get that down payment money back.
Yeah.
And once their bank that was doing finance for the house found that they were trying to do a personal loan to get the money back, they denied the loan.
Yeah.
So unfortunately, the deal fell apart. They didn't buy the house. They got the deposit back because it was pending a loan commitment.
Yeah.
But something that they didn't do. And I talked to the lender on that, and I says, how can this happen, right? It sounds like they just weren't educated enough on what to do, or more importantly, what not to do. Like, don't buy it, don't you?
Yeah, it should be normal spending habits are okay.
Right.
Oh, I pay my credit card. I make my car loan payment. We do this. Anything that's kind of off the grid spending wise,
red flag.
It should be a flag of the fact that maybe I should bring this up. It's the same concept of I'm going to get a large deposit. Well, that's not normally that takes place month to month or week to week. I don't normally drop 10 grand in my bank account. Okay, well, then we should talk about that. Oh, is that a gift from grandma? Is that, where is this funds coming from? So funds are traceable. That's not a problem. We do gifts all the time. Actually, in the last year, gifts have become easier, especially with government-based loans, where they actually look at the gift tracing similar to conventional financing, which it was a little more difficult previous to that. I think that changed maybe, like mid-year.
How does a gift work?
So, all right, let's say I'm your brother, right? and I'm going to give you $10,000, right? One, I want to be able to trace this entire process. We got to show, hey, we have a relationship. That's the first part, right? Right. We're family. Okay. The other part too is we have this gift letter, right? It's a generic Word document gift letter. Any lender you deal with, they all have this generic gift letter, right? Gift letters, name people, who's involved, don't need to pay it back. It's all kind of on this letter, right? In the easiest way to trace it is me giving you a personal check for $10,000, then you cashing it in your bank account, right? Now, once it clears my account, I can view an image of this check. We call it a canceled check, similar to like when someone makes a deposit on a mortgage, right? When they're trying to buy a house, right? So we get an image of this check, and depending age demographics, sometimes people don't have checks anymore, right? But if you ever write a utility check, it's the check you see at the back of your bank statements. We're looking for that check. So this plus your bank statement receiving the funds plus this gift letter. Done. We've traced the process. And that's the easiest way to do it. Sometimes it's a little bit more when, say, I'm wiring the funds to you. So if I'm wiring your funds, it's easier if it references, say, the donor, like my name in there or an account number, so then I can trace it. But there are definitely avenues to do it. As long as it's coming from a trusted source, usually you can get this. Now, getting it last minute in a transaction, not smart. Let's have these conversations up front, so you're doing it within the first week of that transaction. So if you're doing a home inspection, usually they say, hey, let's wait for the home inspection to take place. Green light, okay. Let's order the appraisal, and let's in that same breath, let's initiate that gift. Yep.
So the gift letter for down payment assistance for me to buy the house, does it have to be from a family member?
So sometimes what happens is the person buying the house, it's not ideal, but sometimes it happens. We just figure out a way to do it. But is someone's making an offer, they're like, I don't have checks, but their parent might be there. And they say, well, I have a checkbook with me. And is that what you mean? Like,
no, I mean,
they write a
the
check.
gift letter, like, it doesn't have to be from a relative to get.
Oh yeah.
It has to be from a relative.
Yes.
Okay.
Yep. And the terminology is kind of like a family-like relationship, but yeah, relative is definitely ideal. I would say 90% of the gifts that we see are from parents or grandparents.
Okay.
The other thing too is depending, again, we talk about CPAs. The donor may want to reach out to an accountant or their accountant to confirm, because I don't want to be the one guidance. I'm not a CPA. If they have any tax implications or anything like that for that gift, we always recommend someone to look into that too if they're considering doing that.
How about if a buyer wants to purchase a investment property and live there, whether it's a 2-family, 3-family, owner occupy, right? So they get some rents to help out with the mortgage going into qualifying for that mortgage. Obviously, you can take the market rent, or if there's a lease, you got to honor that. But how does the rent income from the other units play into qualifying for a buyer to buy a multifamily house and live there?
Okay, so let's first talk about right. So we talked about qualification earlier. Is gross income divided by monthly debt, right? That's how we're qualifying, right? And part of that debt is this new mortgage, right? So now if I'm going to buy a property owner occupied, right? That's a multifamily. So this is a 2-unit, 3-unit, 4-unit, something like that. Now remember, if I'm buying an owner occupied, I could put down 3.5%, I could put down 5%, I could put down a much minimum down payment, as long as I'm living there. So if I'm living there and I'm occupying X unit, I'm gonna use 75% of the rental income on the other 2 units or 1 unit, whatever, how many units are being rented. We're gonna use that, and that's gonna add to your gross income number. So when we're qualifying, it in a way brings you up to that next level for purchase, but then obviously their monthly obligation is, yes, it looks like they have a much larger mortgage payment because they do, but they're also getting rental income to offset that, right? In a way. So you can use, the average is probably about 75% of that rental income. That's what most of the times that we're using it. If you're truly buying it just straight as an investment property, you're going to be required to put down anywhere between, if it's a single family or a multi, the common's 20% down on single families or 1-unit properties. So it could be like a condo, or a multifamily is 25% or more.
I feel like that's a great investment hack. You're going to live there, so you have the ability to put less money down. Versus if you already had a home and you're buying a multifamily and it's investment, you might be looking, 25% down for the purchase price? Which is a huge difference, right?
Exactly.
So if you're looking at a property that has leases in place, let's say they have 6 months left on the lease, and the rent is less than market value,
we do. So one, if you're buying a property that you're going to be occupying, a unit has to be vacant. When you close, that's a really big piece of the puzzle. If there are current rentals and lease agreements that are signed, unfortunately, the appraiser is going to have to honor those lease agreements when we're doing the qualification. So there are a lot of properties that are turning over that maybe this person's been there for 15 years and they really haven't increased their rent. They're paying peanuts, you know, and it really should be double this number. And that new person coming in is like, I'm doubling this number in the next 12 months, but we can't use it yet when we're qualifying. So that's why it's really important dealing with like an expert like yourself. You're reaching out to the listing agent, finding out, hey, what is going on with the lease agreements? So we're not finding something out last minute, right?
Right.
Yeah.
Point.
Now, when we were talking about investment, the other thing we should kind of talk about a little bit is, you know, the Airbnbs have become that kind of second home situation has kind of popped up a lot in the last couple of years. So I've found a lot of people kind of getting closer to retirement are now buying like this property down the Cape. They're buying the property down Narragansett. They're buying them in New Hampshire, and they're buying these properties. They're financing wise, almost think of it like an investment property. You got to put down your 20, 25%, right? Because it's a second home or it's an investment property. But if you're now renting it out to help offset that cost structure, people are doing that because their goal play long-term in the next 5 years is to eventually retire and move to that location. I've seen a lot of people doing that lately too.
Now, if you already own a single family home and you're buying a second vacation home, what's the minimum that you can put down to purchase a property? Isn't it less than?
So years ago, it used to be 10%.
I remember because when I was buying,
yeah,
it was 10%.
I myself, same deal. During COVID, that rule changed, and they treated it like an investment property because you had a discount back then, not now. You had a rate that was only a slight increase from primary purchases. It was like an eighth or a quarter higher, and then you put down 10%. So it was like a huge win for someone trying to buy a second home. Once COVID hit, they realized that so many people were really buying these as investment properties. So we kind of caught on, right? So what ends up happening is now your rates are really based more off investment purchases, even though it's a second home. You do have the ability to put a little bit less money down, but the interest rates are not friendly, right? So can you put less money down? Yes. But when I do the math and you actually break it down, putting down that 10% or something like that, the rates are astronomical. It does not make sense. The way the rate sheets kind of break down, it's definitely beneficial to hit like that 20, 25% threshold, or you're paying a lot of extra costs that I don't think is worth it for a consumer.
Right.
Yeah.
So based on I know a lot of people come across this based on the condition of the property they're looking at.
Yep.
Some won't qualify for certain type of loans. Can you kind of touch on the different types of loans that you see most buyers are using, and when it comes into a problem with the actual condition of the property, like with the FHA and things like that?
Yeah, so that's a good question. So a lot of these properties that are being sold have not been maintained, right, in the market today. There are different forms of renovation loans or rehab loans, right? The most common you'll hear is a home style renovation loan, which is a conventional version of a rehab loan. Right? So conventional financing is like, you know, you're 3-5% down in most cases, right? So your conventional financing, and you hire a contractor, and this contractor works together with us. We quarterback this whole thing together, and we're dispersing funds as this contractor is doing the work to get to wherever you're trying to get it to. The other common one is the FHA 203K loan. This is a government-based loan. This one's more of a 3.5% down scenario. Very similar, just the government-based loans have a little more restrictions in regards to the appraisal. So if you are trying to make it meet the guidelines for a 203K loan, you may be required to do more work to the property than if you did the home style renovation loan, right? If someone actually had the choice, I would lean home style renovation loan if you had that ability.
Gotcha. Excellent.
Yeah, but you can repair a septic with this, roofs, you can get appliances, you can redo a kitchen, you can do a lot of things with that type of loan. So it's a nice piece.
And a lot of times you hear about holdbacks for closings when, you know, properties need work. What's that? I know a lot of banks are not really in favor of doing that, correct?
Yeah, we don't love holdbacks. Usually the most
Can you explain what a holdback is?
Yeah, so a holdback is that let's use a common holdback sometimes in the wintertime. If you're closing on a property and it's a government-based loan and there's chip paint, so the paint's peeling on the side of the house, right? Normally, the paint needs to be repaired in order to close on this property. So we end up getting a quote on the paint, but you can't paint when it's cold out, right? It doesn't stick, right? So you have to paint within a certain time frame. We actually hold back 1.5 times the projected cost structure of the paint job, right? So if the paint's $2,000 is the quote, we're going to hold back $3,000 from the seller. It's going to be held in escrow, and we have the contractor teed up. So when, say, like a spring hits, like say if it's April or May, now it's warm enough. Okay, now we're going to paint this place, and it's going to be good to go, right? That's a common holdback, but usually it's weather-based is where we're okaying holdbacks. But yeah, they're not as common. Banks don't love to hold back funds for sure.
Gotcha.
Yeah, we like it to be done. Right at the table. But this is the point, right? So what you were just saying to me, right? You're like, okay, wait,
start off.
what
You
do we
know
miss?
you know we're gonna
So
start
what do
off.
we miss? What are we missing? Some of the stuff that we haven't brought up, right? Is we haven't really dove in too much. We talked about roughly payments, things like that. Every scenario is different, right? So it's, if your neighbor bought a house, or your friend bought a house, their scenario is completely different than your scenario, right? Credit scores drastically can change this thing, right? I know you're going to be having one of these sitting down with Adam Briggs, who's great at credit repair, and he's going to talk about a lot of different things too, so he can give some guidance on that. But kind of like the guardrails, if you think of credit, is roughly about a 580 is like your bare bone, right? But it is better if you can get into that 600, 620 world, a lot of stuff starts to open up. That's really what it is, right? The 580 is the base of the tree, but if you can get up into the 600s, it really makes a big difference. And then think of it as incremental spots every 20. 600, 620, 640, 660. Every time you're hitting that threshold, more things potentially open up, right? Credit scores drive a couple things. They drive the interest rate at times, they drive the program at times, and they drive the mortgage insurance, right? So private mortgage insurance, or PMI, is associated with loans when we don't put 20% down, right? And in most conventional loans, there's a risk to that. So it's insurance, right? Just like you got a car, right? It's insurance, it's based on risk. So if you don't have a strong credit score, that monthly premium might be higher on that PMI or mortgage insurance, right? So it does play into it too with the credit scores. But there are ways that we can actually, with credit, say someone's 3 to 6 months down the road and we're just kind of preparing and giving guidance. A lot of times we'll do a soft credit report. So if we do a soft pull, it's really not as much. I look at it as in like we're looking at the bureau, we're not going in the underwear drawer scenario, right? It's a soft pull. It gives us an idea of a score, but also it gives us an idea on some guidance, right? Maybe we need to pay down a couple things to get that score to jump, and they're only 3 to 6 months away. So with that, plus we talk about their comfort levels on their mortgage payments, well, now they're like preparing over the next 3 to 6 months. One, their credit score is going up, which is going to help us when we're trying to buy. And then also maybe they're setting aside the $1,000 difference that they're going to have in a new mortgage payment from what they pay for rent. So they're now starting to get a feeling for what that payment's going to be moving forward. So that's something that I definitely wanted to address. And then the other thing was on regards to closing costs, right? How much do people set aside for closing costs? These down payment assistant type of things, there are ways to roll in certain closing costs. The most common over the chunk of years, and I've been doing this about 20 years, I think you're very similar to that time frame, is really seller credits. They've come back, right? All this stuff disappeared for like 5 years, right? But you're seeing people getting home inspections again, which is great. You're seeing people getting seller credits now to help offset the cost. Every $10,000 in a mortgage may only move the payment about $60 to $70 a month, right? So a lot of times when you make an offer on a house, you could actually increase the sales price a little bit and roll in a seller credit. That seller credit, it's a paper math transaction. But what will end up happening is it will lower your cash to close. Closing costs, if I'm buying a $100,000 house or I'm buying a $500,000 house, only a couple things actually adjust. Mostly it's title insurance is the biggest thing that's going to change, which ends up being through the attorney, and then whatever your taxes and insurance is on that property. The other cost structures are very, very similar. A lot of people use between like a 2 to 3% of the sales price. If you've ever heard that, like 2 to 3% of your sales price is roughly what the cost is, but everything is so different per person. So I think if we're talking to somebody, it's better to really give the guidance when we speak to somebody on the phone, right, about what that would be. Most people say the average is anywhere between $4,500 to $5,500,
Right.
as an idea, right? But really, until you get actual numbers on somebody, you can't be really 100% accurate on that. The other part is that we normally escrow your taxes and insurance. So when we're escrowing, what that means is that when you pay your mortgage payment, you pay your principal and interest payment, you pay your taxes, insurance, if you have mortgage insurance, and then you got your total payment, right? But taxes are paid quarterly in a town, and insurance is paid annually. So what ends up happening is at closing, we actually collect 12 months of insurance to pay a year ahead. We collect a quarter of taxes, pay it ahead. And then we set up 3 months of insurance, 2 months of taxes, and set up this little kitty over here.
Yeah.
Right? So this kitty, every month when I pay my $3,000 mortgage payment, tax and insurance go into this account. And we pay taxes quarterly out of there, and we pay the insurance annually. So depending on what tax and insurance are on that property, you could be adding another $3 to $5 grand to this number. Right. So that's why it's kind of a moving target. But it's a really good idea if you talk to somebody like yourself or myself, we can break it down a little bit more in depth for somebody, but you can roll those costs in too.
Now, as far as we're talking about seller credit, how can that play into some of these loan programs where you can have it prepaid, like the 2-1 buy down to help with maybe a higher interest rate, right? A lot of buyers are kind of like not making that move because, if the rates are higher, either themselves or people telling them, don't buy, rates are up, wait for them to come down.
Yeah, it's almost like a payment shock to them.
There's programs out there to help with a lower interest payment. And let's face it, when rates do adjust, a lot more buyers get into the market. There's a lot more competition. It can increase the price of the home, so you end up paying more for the home, even though the rate's down. A lot of people are saying, hey, buy the house now where, there's not as much competition. You could probably get it for less money now than you can later in the year.
Yeah.
And refinance when it comes down.
Yeah, it's true. I mean, every time interest rates drop a percentage point, X amount of people now qualify. And they're going to jump and they're going to come back in the market. There are certain things that you can do. So right now, we can't predict the rates, right? We can't say we'd all be gazillionaires, right? If we could predict the future, right? Mm-hmm. But there's a lot of confidence in the upcoming years that rates will be lower than they are today, right? So if that's the case, there is a way to bridge that gap. So bridging that gap is kind of what you're talking about. Where we were saying seller credits where you can roll in certain cost structures, you can roll in certain escrows or certain cost structures to help offset a mortgage payment for a period of years. So maybe you're offsetting a mortgage payment by a percentage point in an interest rate for the first year, and then maybe the next year it's by 0.5% or something like that. Mm-hmm. So as an example, what that means is, so not using real rates today, but say a rate was 7%. It'd be like year one, you're paying a 5% interest rate, or we'll have the feeling of paying a 5% interest rate because we've set aside in escrow the difference of that payment. Year two, you pay a 6% interest rate because we've set aside the difference of that escrow right here, right? So year one, you have the feeling of 5%, year two, 6%, year three, you're back at 7, wherever that rate is at that market. Right? Now, what's great about that is it helps offset, could be a couple $100 a month for the first 12 months. Maybe it's $400 year one, $200 year two, but maybe you've already bridged the gap. Now it's time to refinance, right? And that's kind of what you were saying.
Yeah, if you get the appreciation, you get the equity.
And if you have any money left over in that escrow account, because it hasn't been used yet, maybe you're only 1 year into the 2 years that you set aside, that can be applied towards your principal balance too with a refinance. So that's another benefit too.
So it could be a way to buy some time. We're paying like you have a lower rate, right?
Yep.
And then the hopes is as the years go on, the rates get a little bit, you can either refinance out of that.
Yep. There's always options.
Yeah.
There's always options for sure.
Excellent.
Yep, for sure.
All right, John. Well, thanks for coming in today. I appreciate it.
Yeah, thanks for having me.
A lot of good value. Absolutely. And how can someone get a hold of you for any additional information?
Yeah, great question. I mean, any additional questions that someone might have, you can direct message us. Our Instagram account's john.libman, as well as our website is localmortgageteam.com.
And to get a hold of me and the Gavere Real Estate Team, you can reach out to our website, which is thegavererealestateteam.com. And also our Instagram, TikTok is all the same Gavere Team as well.